Hi there. How do you analyze a publicly traded company financial statement? In this video, we're going to look at two examples, Facebook and Snapchat, and compare both companies and give you the analyst perspective on how we read and analyze their financial statement. In addition, this is meant to elevate your understanding of financial statement analysis and help improve your decision-making process of whether you should buy the stock, and if you own it in your portfolio, should you sell and liquidate the position. So with that being said, let's dive into the material. So the first thing I want to show you is an investment presentation put together by one of our students in our analyst program so that you can understand how in depth we analyze a company when we're combining the research and also the technical skills of financial modeling and valuation. So right here, what we're displaying in our screen is her investment presentation on Facebook. So I'm going to quickly go through this because I want to focus more on the financial statement side, but just a few slides to notice. You have her company profile, which details their business operations, global footprint, their different products like Oculus, WhatsApp, Instagram. In addition, the overall experience of the user. So she basically went a lot in depth into the situation and the fundamentals of the business. Financial performance slide, the industry, how big it is, and what is Facebook market share within the industry. Competition, you can see down here Snapchat, which is a company that we're going to compare Facebook to. And again, this is meant to give you more of a deeper understanding of the process and the amount of homework and research that you need to do on your own to better understand the business. So here's the second part of her presentation, which is the financial statement. So here we're displaying the income statement. On the income statement side, I'm going to point out the operating amount, their operating income. Notice that it's pretty consistently profitable. Look at the income statement. Same thing, it's consistently profitable. But when we review and analyze the financial performance from an income statement perspective, look at the margins. The most notable margin here that stands out to me is EBITDA margins, which is an approximation to how much operating cash flow the business is generating. You can see that in 2020, when you compare the Wall Street estimate versus her own numbers are reflected in black fonts, and Wall Street consensus is represented in red color fonts. Look at this, 47%, then 50%, then another 50% the following year for 2022, then 49%. It's a 50% EBITDA margin business. Not many businesses can generate that high level of profitability from a margin standpoint. And when you really think about their business, there's no heavy capital investment in machinery or equipment, because what they've done is they've created a platform that allows users to create content. It's essentially content. And you can see how profitable Facebook is. And of course, they're selling advertising through their platform. And look, they've gotten their setbacks and a lot of criticism relating to politics, relating to some of the messaging that they're allowing in their platform and not putting the right systems or checks and balances in place to mitigate hatred and negativity on their platform. That's why you saw major companies like Verizon pull back on their advertisement expenditures. But I think that that's a temporary setback. I think that these companies are going to come back into the platform and they're going to continue to spend in advertising, because from a return standpoint, the amount of money that you're spending in ad dollars, Facebook is perhaps the only platform that gives you the highest return on your investment per ad dollars. They're actually better than Google AdWords. And myself as a user of Facebook, in terms of advertising, I'm getting to see that return on investment. So they've built an amazing platform. And the margins, what they are generating, I think this is going to be consistent. So this is a healthy income statement when we're looking at the profitability and looking also at the margin. The other thing that you may want to incorporate and look at when you're reviewing the income statement is revenue growth. Look at in 2018, revenue grew by 37%. Look at 2019, grew by 27%. And then what the street is expecting beyond 2020 is double digits, 24%, 19%, 16%, 11%. So this is healthy growth on a company that is generating revenue of over $60 billion. And of course, that's going to continue. So by 2025, this student analyst is expected revenue to reach 130 billion by 2025. So this is just one way of reviewing their income statement, but more importantly, looking at their margins. Then if we dive more into the balance sheet, you can see that it's nice and healthy. They have a healthy amount of cash available, cash and equivalents, okay? You can see also marketable securities, around 35 billion. Okay, any type of long-term debt? No major long-term debt. So this is a healthy balance sheet just from what I'm saying. And their current assets definitely meets their current liabilities. If you're looking at working capital or net working capital, this is fine. Let's look at the cash flow statement. When we look at the cash flow statement, the first thing I like to look at is cash flow from operating activities. This is positive, which indicates that the business from their core operations is generating cash flow. Remember when we looked at their EBITDA margins, 50%? Well, that is an approximation to how much operating cash flow the business is generating. This is strong, it's healthy. When I look at the financing activity section, I can see here operating lease drawdowns. This is fine, nothing that sticks out of me that might be a concern. The other major point or the major line item that I'd like to look at is free cash flow. You're seeing right here the free cash flow is positive, it's healthy, it's growing year over year. This year in 2020, the estimate based on the assumption that this analyst uses 31 billion. The following year, 34 billion, followed by 43 billion, and by 2025, they should reach almost $60 billion in free cash flow. That's a healthy number because when your business is generating free cash flow, that means that they have excess cash to either pay down the debt, buy back their own shares, issue a dividend, reward you as a shareholder, and also reinvest in the business or make future acquisitions to grow their operations. So that this is a healthy cash flow statement. And also, when we look at the valuation of Facebook, looking at their peers, one company that actually stands out, and I mentioned earlier, is Snapchat. Look at Snapchat when you're looking at comparables or competitor universe of Facebook. Snapchat on an EBITDA basis, see this number here says NM, this is not meaningful. They're actually losing money. When you compare it to everyone else in the industry, they're making money. Now, there's Microsoft. Microsoft obviously owns LinkedIn. You have Google. Google owns YouTube. You can make an argument that it's also a social platform except with video content. You have Apple here, you have Amazon and Netflix. These could be a little bit more creative, maybe stretching it a little bit because I don't see them having any pure social platform. But then you have Snapchat and Twitter. But with Snapchat, when we look at their financial statement, there's a few things that are important to recognize, especially if you are a shareholder. But let's continue here more into her valuation. Here you have comparable company analysis from a multiple standpoint. This is her DCF analysis. This is her FUPO feel where she blended different methodologies and arrived to a reasonable valuation for the company. But more importantly, the different price target under each of the scenarios. So here she had an upside case where the price target was $340. Here she has her bear case with a price target of $220, and here she has her Wall Street consensus case with a $305 price target. Ultimately, her recommendation on Facebook was let's pull up here the final slide, was a buy rating with a $305 price point. So this presentation is really meant to show you the level of research, the level of technical skills that you need to apply to become a smarter and more sophisticated investor, where your research, your analysis, your assumptions support your price target, and then you can make a smarter, a more informed decision. So it's a lot of work, folks. What you're seeing right here, it takes time to develop that. And again, this is more than opening up a trading account and hitting the buy button. There's a lot more that goes into that decision-making process. And this example is just really meant to give you a little bit more transparency to educate the public on the amount of research and knowledge that you need to have in order to do it at this level, okay? And of course, we can simplify a lot of these things as well. Now, let's look at Snapchat financial statement and let's see how we can analyze, read it, and interpret it a little bit more closely. So what I'm gonna do here is pull up their SEC filing, the 10K. Okay, here it is. So the first thing you wanna do is look at the share structure. How many shares outstanding does Snapchat has? And also pay attention to the voting rights of the business. So if I scroll down here, you're gonna see that on the first page, they have 3 different classes of shares, okay? They have Class A, they have Class B, and they also have Class C. So 3 different structures of shares. Now, what about voting? Who gets to vote? As a public shareholder, do you have a say in terms of what happens with the company? Can you voice your opinion? Let's look at that. So what you can easily do to find the voting rights of the companies is to quickly do a quick search filter. Let's do Control F on my end. And let's type voting, okay? And let's see what information here do we find on voting. This is quite interesting. Look at the first sentence under their vote, under the majority of voting and controlling interest. Look at this first sentence of what they're saying. Our 2 co-founders, Evan Spiegel and Robert Murphy, own or control voting shares of our capital stock that represent approximately 99% of the voting power of our outstanding capital stock as of December 31st, 2019. They basically control 99% of all of the voting. So if you are a public shareholder, if you own shares in Snapchat, from a voting perspective, you're basically muted. You cannot voice out your opinion because it doesn't matter what you think about the business. The founders, the co-founders, have 99% of the vote. So whether it is decisions about the strategy of the business, decisions about hiring additional employees, adding members to the board, changing their operations, their business plan, all of those decisions, the important decision process of the business is all basically in the hands of the 2 founders. So as a shareholder, that right there may serve as a huge roadblock or challenge for you to be a shareholder. And I remember when Snapchat was going through their IPO process, this was a major red flag in some of the concerns that shareholders were voicing out during their roadshow. So this is something very important for you as a public shareholder to understand their voting power and their different structures of shares. Now let's look at their income statement. Let's see how they've been performing. One way of thinking about a company's income statement, it's kind of like a report card. It is sharing the financial performance of the company. And we can basically validate and see how they have been performing. The decisions of running the business, have it been profitable? Have they been effective in their operations and their mission? Well, let's take a look at their income statement. All right, so I'm basically scrolling down to the consolidated section of their 10K and pulling up the income statement. Okay, so here's the income statement. We can see that in 2017, right, their operating income, it was actually an operating loss. Look at this. They lost $3.4 billion, which trickles down to their net income, $3.4 billion in 2017. I mean, that's a huge loss. 2018, their operating income, they lost $1.2 billion. This trickles down to your net income, to $1.2 billion loss. If we look at 2019, they lost $1.1 billion from an operating income standpoint, and of course their net income is going to be very close to that. They lost $1 billion. Then their earnings per share on a basic and diluted share amount, you can see in 2017 they lost $2.95. In 2018 they lost 97 cents, and then in 2019 they lost 75 cents. So for the last three years of financial performance that we're seeing here, we can simply summarize that they've been burning and losing a lot of money. Now let's look at the balance sheet. Let's see the balance sheet. Here it is, okay? From a balance sheet standpoint, you can see their cash and equivalent, okay, $520 million. You can see right below that is marketable securities. They have about $1.5 billion. Let me remove this to make it a little bit more clear for you. There it is. And when I compare their current assets, okay, to their current liabilities, from a working capital perspective, they have more than enough liquid assets, more than enough capital to meet their short-term obligations within a year. They do. So what's concerning to me is why would you have $1.5 billion in marketable security? Marketable securities is essentially short-term liquid investment. It could be a CD. It could be treasuries, short-term U.S. government bonds or treasuries that mature in 3 months or less than a year. That could also be investment in stocks, in other company stock. So this is very liquid. So that's $1.5 billion. Why would you own on the books $1.5 billion of marketable securities when you have more than enough capital to meet your short-term obligations? You should probably use the excess amount and reinvest it into the business to improve your operations, to improve the product, to come up with new features. Okay, so this is how I think about it. Now let's look more closely at the cash flow statement, because the cash flow statement gives us how the company has been managing their cash inflow and cash outflow. So let's scroll up and pull up the cash flow statement. Okay, so here is their cash flow statement. You can see that on the heading we have 2017, 2018, and 2019. So the first thing is cash flow from operating activity. Here it is. Negative on each year. 2017, they lost $700 million. 2018, they lost $689 million. And then in 2019, they lost $300 million. You could see that. So let's see a little bit more carefully where the numbers are coming from. Well, obviously from their net income. But here's something that does stand out to me that I find quite interesting. The second biggest number in their operating activity section is their stock-based compensation right here. Look at their stock-based compensation in 2017, $2.6 billion. Then the following year, 2018, $538 million. Then the following year, $686 million. This is concerning to me because stock-based compensation essentially means that they are paying their engineers, their sales staff with stocks. This is how they're compensating them or incentivizing them to stay within the company to help develop the new product and features. So they're giving them shares. Then the engineers, the staff, or the sales people within the company, the employees that are receiving these shares in the form of compensation, they're selling it to the public. So they're selling it to you. So now you have two things going against you. Number one, you have no voting right. 99% of the votes is concentrated with the founders. Number two, excess amount of share-based compensation to their employees in which they're turning and selling them to you in the open market. So you have two things going against you as a public shareholder. Now let's examine the second section of the cash flow statement, which is the investing activity section. Let's clear this up. Here is the investing activity section. Okay. In terms of investing activities, you can see the cash outflow of the business. In 2017, right? 2017, right here. Look how much they spend buying marketable securities. $3.8 billion. Okay. Then of course, some of those securities were mature and they actually liquidated some of them. So here's the liquidation amount. Okay, so they're engaging in buying and selling marketable securities. Fine. Look at what happened in 2018. They bought $1.6 billion in marketable securities, and then okay, some of them mature and they sold some of them as well. Okay, fine. Then in 2019, now this is 3 years in a row, they increased the amount to $2.4 billion that they purchased in marketable securities. But then some of them mature and they sold some of them. You're seeing it down here. Okay. So they're basically engaging a lot in buying and selling short-term securities. Stocks, bonds, CDs. It can also be commercial paper and U.S. Treasury bonds. So if they're engaging a lot in short-term investments, essentially they're acting like a hedge fund. $3 billion purchased in 2017, then $1.6 billion purchased in 2018, and then $2.4 billion purchased in 2019. I begin to wonder, are they profitable buying and selling marketable securities? So that's a question that we need to answer, because if they're not profitable, then they're using the cash of the business, they're using shareholder money essentially to gamble and sell and buy securities in the open market. I mean, they're basically running it like a hedge fund, right? But keep in mind that their operations, they're still losing money. So they haven't fixed that part yet. okay? So the other thing you want to look at is, are they still doing the same thing year to date in 2020? Because these financials are for 2019, 2018, and 2017. Let's take a closer look at their most recent financial statement, which I have up here, okay? Here's now the cash flow statement for the last 6 months of 2020, okay? Look at their purchase of marketable securities and the maturity of those assets. So in 2020, they bought so far 1.4 billion in marketable securities, and you can see here the net proceeds of selling their marketable securities around 1.4. So the net amount is probably 0. Okay, so they're still engaging in that operation in 2020 year to date. Let's go back to the 10K, which is the annual report, okay? Let's examine more carefully their financing activities section, okay? That's this part right here. Look at 2020. Look how much money they raised from investors. This right here is proceeds from issuing stocks, okay? They've raised $2.6 billion in 2017. They haven't raised much capital, and I think they're finding it very difficult or challenging to raise capital. After I'm noticing that they're spending a lot of money in marketable security, they are rewarding a lot of their engineers and sales staffs with shares, which essentially means if I give you money, you're gonna dilute me, and I cannot voice my opinion. I cannot object to your decisions because you have 99% of all of the voting rights, and I'm basically a silent shareholder. I'm giving you a blank check to do whatever you want with it. So again, these are the things you need to understand when you are a shareholder of any publicly traded company. Where is your money being taken care of within this business? In terms of continuing to fund their operations, right here, I can see right here, they've essentially issued proceeds from issuance of convertible notes. So they issue a convertible note, which is a bond. So they manage to raise money from bondholders, and then they can convert that into shares. If the stock increases, therefore they'll make a better return. So they were able to get financing from lenders in the amount of 1.2 billion. So here's what I want to do now. Now I want to see how much money they've actually made from their marketable securities activity, from engaging in buying and selling marketable securities. So I'm going to pull up here my spreadsheet in which I've already done this calculation, okay? And here's the numbers. So in 2017, here's the net amount, right? The amount of money that they purchased, 3.8 billion, and the amount of money that was mature and what they sold. So net for 2017, they lost $868 million. In 2018, net, they've basically made 829 billion, or their cash inflow from that activity. Look at 2019. 2019, it was a negative amount of 684 million. And year to date in 2020, in the first 6 months of the year, is $18 million. But when you take the aggregate amount of all of these numbers on a net basis, net amount over 3 years, $700 million, folks. So engaging in marketable securities, buying and selling over 3.5 years, they've lost $704 million. I mean, let that sit in with you. If you are a shareholder of Snapchat, are you okay with them losing $704 million of your own money when their operations is still bleeding and burning through a lot of cash? They haven't fixed that yet. They're not profitable. So why are they engaging in buying and selling marketable securities like if they're a hedge fund, like if they're a money manager? As a shareholder, I will be voicing out that opinion. But don't forget that your opinion doesn't matter because 99% of the share vote is concentrated with the founders. So essentially, it's kind of like a dictatorship. It's not a democracy. You cannot voice your opinion. You cannot fire them. You cannot change them. They cannot change their plans and operations because you gave up that right when you bought their stock, when you decided to invest in this company. So are they keeping your money? Are they putting shareholders as a priority? Do they have your best interest in mind or your best interest at heart? I don't think so. by the way that they've been burning through cash, compensating their employees, and engaging in buying and selling marketable securities, again, like if they're a hedge fund, and then losing $700 million over the last 3.5 years, I wouldn't give them my money. Absolutely not. So this is really meant to give you a different perspective on how we as analysts read and evaluate the financial statements to see how the company or the management has been operating their business and what their decision has led to, the results of their decisions. Now, of course, we may also look at the future. Maybe they're going to become profitable a year or 2 years later. I've included that information here. So Wall Street consensus estimates, or what analysts are expecting Snapchat earnings to be. So in 2020, their EPS, their earnings per share, is expected to be minus 71 cents. The following year in 2021 is expected to be minus 44 cents. Then in 2022, it's expected to be minus 16 cents. In 2023 is when all their analysts, the analysts that do cover Snapchat, believe that they're going to become profitable. Therefore, their earnings per share would be 21 cents a share. But here's the thing that you need to understand with social media companies. Their main target audience, their main target demographic is who? Teenagers. Teenagers are susceptible to trends and fads. So 3 or 4 years from now, who knows if the teenagers that are using Snapchat are still going to be using it. Something new might come up. Maybe Facebook might introduce a better feature and a better product that competes with Snapchat and causes their users to stop using it, right? So looking into the future, so many different things can emerge in the technology space, especially in social media. So I look at this profitability standpoint of 2023, 21 cents a share of profitability. I looked at with a healthy dose of skepticism, okay? So I just wanted to share this with you to give you a deeper understanding of how we read financial statements from an analyst perspective, how we can look at a company's decisions and the results from engaging in marketable securities, and also look at their profitability if it even makes sense. Are they taking care of your money? Are they putting your best interest at heart, especially with their voting structure? Again, folks, I hope this helps you. I hope it improves your understanding of reading and analyzing financial statements. If you own shares in any company, you should be doing this exercise to each and every one of those stocks. If you're not doing that, then you're basically being lazy. I'll say it. And it's also showing that you're not putting the amount of research, you're not doing your own homework to evaluate and analyze how management has been running and operating their business. If you're giving them your money, you better be evaluating their performance. This is one way of doing that, all right? All right, folks, I hope you found value in this, and I hope, again, this continues to improve your understanding. So with that being said, take care, stay safe, and I'll see you in the next one.